Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now is Derek Halpenny on foreign exchange. It's been way too long since we've had him on. He's just done a great job at MUFG for decades. Derek, let's go right to the dollar with the tests that are going on. Is it dollar resilience that you observe?
Well, when you consider the level of expectations that were surrounding Inauguration Day and Day One tariffs being implemented, yes, I think the correction weaker when you consider the scale of dollar strength in Q4 of last year, I think is still pretty moderate. And for obvious reasons. You know, I think you'd be a brave man to be selling the dollar here when you listened to Trump last night and the way he was talking about trade tariffs and how he loves them and all the advantages. Tariffs are coming. It's just a matter of when.
Right. You are expert at flows. What are the flows from the continent to America, vice versa, or from the Pacific Rim to America?
Well, speaking from an MUFG perspective, the Pacific Rim, to Japan, and both, Japan to the United States from the Pacific Rim, and also in Europe, there's definitely been reduced appetite for fixed income investments, and I think in that it partly reflects the increased cost of hedging for Japanese investors has curtailed their appetite because, as you know, Tom, there's an appetite for fixed income, but also hedging that to some degree. And the cost of hedging, I think, has brought down overall the buying of fixed income in the United States. And it's even more obvious in Europe, where Japanese investors have been outright sellers, probably on political risk, in France in particular, where we've seen some heavy selling of French bonds over the last couple of months.
It's interesting because Chris Ferrone over at Strategist was pointing out yesterday that how, if you're looking at the performance for technology stocks and how they peaked in July when the yen first strengthened, if you're looking at the US dollar versus the Japanese yen, still around that 155 level, what are you watching there? And how does that kind of, in relation to what we saw with China, their AI model, what that means kind of more broadly when you're looking at this space?
Yeah, we had an interesting move yesterday. The Japanese yen was the clear outperformer. And I think if you look at the cost of hedging, going back to that point, and by that I mean just looking at 3-month money spreads, because a lot of Japanese investors hedge on a 3-month rolling basis. The cost of hedging is coming down, and it's coming down steadily. And as that happens, that obviously incentivizes Japanese investors to hedge more, which is essentially yen buying. And if that flow dynamic continues to gradually change, then I think you get back to the old traditional type moves that we might get, where you have a risk-off scenario, you have a drop in yields in the United States, and you have the Japanese yen outperforming, like what we had yesterday. But, we still have quite a substantial spread. So, of course, today we've seen the yen re-weaken again. Yeah, but I think the story is slowly changing.
But Derek, cut to the chase here. Do you have a vector of disinflation and lower yields? We got Ian Lyngen coming up here. He's in that camp. Bob Michael will be with us on the Fed show tomorrow. I mean, Derek, are you still looking for a disinflationary tendency?
Yeah, well, certainly in terms of a global perspective, I'm quite optimistic on inflation, and I think the battle is effectively close to won. But from a Japanese perspective, it's certainly different. And that's why I think that story is going to continue, where the BOJ continue to raise rates. And then while the Fed may be in for a period of pause, the more favourable inflation backdrop, certainly by the second half of this year, is going to allow the Fed to continue or to restart cutting rates. And then that kind of spread dynamic becomes more favourable for Japanese yen strength. But certainly in terms of the broader inflation picture, I'm more optimistic. Now, of course, we need to assess what Trump does in terms of trade tariffs.
Well, that's what I was going to ask you, because if the global battle is mostly won on inflation, what do you think is the biggest risk?
Well, Yeah, like come to trade tariffs, obviously, because it all depends on the aggressiveness of the trade tariffs that are implemented. Now, if you look right now at the moment at dollar CAD, look at dollar MEX, the moves that we've had in those currencies do not reflect expectations of an implementation of a 25% trade tariff. So markets are still skeptical of Trump's willingness to act aggressively given the near-term inflation risks. If we're wrong on that, and he is much more aggressive, and 25% on nearly 1/3 of your imports would be very, very substantial, then the inflation dynamic is obviously different.
Very quickly here, what's your key pair to make big figure moves? Jess Menton's got to pay back all the Texas A&M betting she did, where she went down in flames. What's the Derek Halpenny pair where I can make some money over the next 6 months?
Well, we have a dollar peak story in about 3 to 4 months. So if I do it over that period, I think the dollar still has more strength to go, but obviously not against the Japanese yen, like I mentioned. So like we think euro can still drop below parity, assuming we do get this period of some adoption of trade tariffs. The Fed on hold probably until the summer. The ECB continuing to cut. I think euro dollar is heading to parity and potentially below.
Derek, thank you so much. Derek Halpenny with us this morning with MUFG.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is a joy. I'm going to spare the long introduction. The densest, most read note on fixed income on Wall Street is without question Ian Lyngen. He wandered through Parchment at Yale University in Minnesota, a CFA, and just absolutely iconic in terms of looking at rates. He holds court with BMO Capital Markets. His compliance told me he is on speaking terms with Brian Belsky. Belsky started drinking at 10 a.m. yesterday. What did you do? On the desk, with correlation here, price down, yield up, is Ian Lyngen buying 10 years yesterday?
I do think that what we saw yesterday was the beginning of a repricing in of the safe haven quality of treasuries. We were reminded that there's more going on in the world than just tariffs, than just the Goldilocks economy. In fact, when things go wrong in equities or in different parts of the system, we see a quick bid for treasuries, and that's what we saw, that stabilizing bid.
You stole a line from Carly Simon, that great song she had, Apprehension. The apprehension is out there yesterday. I get that. But on a vector basis with a Fed meeting tomorrow, can Ian Lyngen say the disinflationary trend is still in place?
The disinflationary trend is in place, but we're trading off of the potential for a forward reflationary one based on tariffs, which frankly, I think is somewhat overblown at this point. We are going to enter into a period where the data is confusing for the Fed because we'll have a floor in the realized inflation data as a function of the tariffs that presumably are going to be rolled out over the course of the next several quarters, and that's going to make it very difficult for the Fed to get back to normal.
Do you have a magnitude adjustment of the tariff in that, well, I guess the line now is going to ramp in tariffs, but does Ian Lyngen make a distinction between 3%-ish all-in tariffs versus the magnitude the president's talking about? Those are two different stories, right?
They're two entirely different stories. However, I think the most important aspect is whether or not it's gradual or a one-off adjustment. Because if it's a one-off adjustment, the Fed's going to look at that and say, that's a tax on the consumer, let's move forward. If it's gradually brought in, which I can appreciate from a political perspective, you want to take the sticker shock out of higher prices, but that's an environment where the Fed's going to struggle to really break down the difference between true demand-side inflation and tariff-related inflation.
Looking at the 10-year, obviously it came down pretty significantly yesterday, but up about 2 basis points, around 4.55. But what does speculative net future positioning tell us about how investors are potentially shorting the 10-year?
I think that this is the part of the cycle where it is a make or break moment for the bear steepening narrative. And that is that core short from the speculative community in 10s and 30s that has been persistent throughout a lot of the cycle. I think that we're poised for a reversal. Everyone's been waiting for an opportunity to buy treasuries. They've been waiting for the proverbial dust to settle. Hasn't settled yet, but it's to some extent it's the opposite of what we've seen in the equity market, which is everyone's waiting for a moment to sell. Now people are waiting for a moment to add to treasuries.
Okay, they're going to add to treasuries, and we're going to get the second derivative. Convexity is going to come in, and yields are going to accelerate down. It's away from your remit, but if 10s and 30s move in an Ian Lyngen way, do we get mortgage rate relief? Does the housing market, which we all agree is a train wreck, does it get some relief this year?
I've been very surprised at how long the mortgage basis has stayed as high as it has.
And why is that?
Well, I think to a large extent because of the regional banking crisis, we lost some of the core buyers in the mortgage business, which are the regional banks. They are starting to come back. They're starting to come back slowly. And I think that will compress the mortgage basis, which will, at a minimum, put a cap in for mortgage rates. I don't think that we're going back to a pre-pandemic reality for the mortgage space. Hopefully, at one point we will, but not at this stage. I think there's still plenty of work to be done.
So where do you think the neutral rate actually is, since we're going to have the Fed meeting tomorrow and the debate surrounding that, which is kind of like the million-dollar question?
My key observation in that regard is that it's a moving target. It was certainly higher during the last several year and a half than I think the market was expecting it, and the Fed. I'll also note that the Fed has moved up their longer run dot over the course of the last year. So they've indirectly acknowledged that it's 50 basis points higher at least, so that gets us to 3%. I would say it's probably 3.25, 3.5.
You're the only one I know, Ian Lyngen, who could say the longer run dot and keep a straight face. Ian Lyngen with us, with BMO Capital Markets, an extended conversation, a treat for global Wall Street. Really can't say enough about it. Red and green on the screen. The VIX comes in under 80. Just met in cool calm collected today. It's 17.80. Yields move higher. I look at the 10-year real yield. I only do that to impress Ian Lyngen. 2.15%. We've gone 220 to 210. We're back halfway on the real yield. I guess it's fear of missing out. We'll leave it at that. Jess, save me here with Ian Lyngen.
Well, because of the backdrop, and you were mentioning about the new administration coming in Washington under President Donald Trump, how is the market and the economy different now when he first was taken in 2017 versus what we're seeing at this point? And what does the bond market tell us about the direction of inflation in the economy?
Well, it is a decidedly different world than it was in the beginning of 2017 when he first took the presidency or took over. But what we did see is what we are seeing is a inflationary trend that's higher on average, but moderating versus where it was a couple of years ago. We have a decidedly lower unemployment rate and the perception that we're in a Goldilocks economy that's going to continue in perpetuity. Now, that's a different departure point. One observation I will make, though, is that a lot of the Trump-related trade war initiatives that he put in place during his first presidency were not wholesale unwound. A lot of the tariffs persisted. A lot of that protectionism was already or is still in place, and so we're starting that process from a higher plateau, which does have more potentially negative ramifications for the global economy.
I look at Ian Lyngen at all this, and the heart of the matter is we had a great disinflation, very low yields, negative rates. We all know the drill. Is now normal within the historic span that you are expert at? Are we back to like these are normal interest rates for Kimberly-Clark or the Bank of Montreal and everybody else, Lisa Mateo? Is this normal?
If we look historically, it's very tempting to say, look, we're back towards the averages, we're back at normal. But the reality is that as the real economy has evolved over the course of the last 2 or 3 decades, we have become accustomed to lower real yields and lower nominal yields. So I'll
Right.
argue that we're still at the upper end or the restrictive part of the cycle. And the nuance is that during the pandemic, everyone, including corporations, were able to lock in extremely low long-term financing,
Right.
think of mortgages. And we're still working through that buffer to absorb higher inflation or to drive consumption.
Right.
When that gives, that's when we'll realize how tight policy
Okay,
is.
so a year from now, where's the 10-year yield? Let's just start with that.
Well, we're certainly going to be trading with a 3 handle by the
Okay.
beginning of next year.
We had somebody the other day shock me from Peyton Regal out in L.A., Jeffrey Cleveland, saying a 360. I about fell off my chair. Right. Ian Lingen's not at a 360, right? You're at 380, 390?
Yeah, I think we could easily, at this time next year, we could easily be in a range between, let's call it 365 and 395. I don't think we're at 5.
How do we get there? Brian Belsky's, I'm on IB with Brian Belsky. Brian, thanks for watching YouTube. He's going to ask Ian how we get there. What's the how?
Mm-hmm. The Fed is going to be successful in their ability or in their endeavor to reestablish price stability. That brings forward inflation expectations down. Even if real rates stay roughly where we are, we could compress 10-year break-evens from 260 to 195 or 200 basis
Wow.
points, and that gets us right up against 4% right now.
Okay, for the non-global Wall Street, I'm going to translate that. Is the inflation-adjusted yield, even with stability, the other parts of the yield structure are price up, yield down, right?
Mm-hmm.
Did I do okay there? I only got to page 300 from Bozy. Leave me alone.
Well, actually, like looking at the 10-year, I mean, it was around 3.6 back in September. Obviously, a lot of things have transpired since then, but that wasn't that long ago, to your point.
Mm-hmm.
So how do you think it kind of builds on that?
Well, we were in, let's call it 430 to 440 recently, and that was with break-evens at 210. All we need to do is get forward expectations of inflation to price out the Trump reflation trade and
Right.
start to price in the potential for economic damage to be done from a global trade war.
Does that happen soonest because of rents, OER, and the rest of the housing complex, or is it the price of eggs finally comes in?
I think at the end of the day, what we see is the super core measure of inflation, which is core services excluding rent
Right.
and OER. That printed at just 0.2 in December, and there's downward potential yet to be realized there. I think we could very easily see that because has the high correlation with realized wages, and the employment market, while ostensibly on strong footing, we're at the point where we would expect to see further job reduction and an increase in the unemployment rate. Yet to be realized. I'll be the first to acknowledge that.
If you could ask Fed Chair Powell a question at his press conference
so
tomorrow, what would it be?
I would never ask that question.
Well, the biggest question on my mind, and the one that I suspect that the chair would be unwilling to answer, is we see the dispersion of the dot plot. Which dot is yours? What's the chair thinking?
But come on, they're not going to answer that question. Are we done with the dots? I've been asking this since Richard Berner was at Morgan Stanley, and we're both going mental about the dots. Are we done with the dot experiment? Ian, do you get any value out of it?
So I think that's a very, very interesting observation because the Fed has tried so hard to de-emphasize the value of the dots and their forward predictive qualities. But at the end of the day, the algos and the CTAs, they need something to trade. They need a number.
Why do we care about them?
Right.
We care about the efficacy of America based on a dual mandate. We don't care about the roulette wheel of the CTA machine Monroe Troutman
Right,
did.
because Jim Bullard, who used to work at the St. Louis
No,
Fed,
I'm
would push
serious.
back
Why
against
do
that
we
too.
give a damn about CTAs when we're trying to create public policy here with the Fed?
Well, I don't think that the Fed cares as much about the dots as the market does, and the market only cares about the dots because we need something to trade when the updated SEP hits, and we're not going to trade the growth numbers, we're not going to trade the inflation numbers because they're always overly optimistic and they assume that the Fed's doing their job.
And we won't get the dots this time because they're quarterly, so we won't get them again until March. So there you go.
How do we get rid of the dots, a wise one?
So I will argue that there has been a very concerted effort to increase transparency over the course of the last 20 years by monetary policymakers, the Fed, but globally. that hasn't necessarily translated through to the best outcome. There's a case to be made for less transparency, for speaking a little bit less, giving a little bit less forward guidance, and dropping the dots, I think, could be a reasonable first step towards that objective. I don't think they'll do it, but I could argue that they might.
Well, that's an interesting point because the communication with the Federal Reserve has changed so much, even coming out of the housing crisis with Bernanke. There used to not be press conferences after these statements, especially when Greenspan was Fed chair. And now, once Powell came into play, you started having them after every meeting, not even every other meeting. So how do you think, what would be the sort of way that they would communicate less? Because it seems like the markets want to know every little detail.
I think that the first step towards a more unified communication process would be to be a bit more sparing on how the regional banking presidents speak and how the non-core members of the FOMC are able to air their views, as it were. I don't think that's going to happen, but a convergence of thinking, I think, would be a big key on the messaging side. But again,
I'm busting your chops, but we're getting a huge response on YouTube. Thank you so much. I can't say enough, folks, about Ian Lyngen. As someone out on YouTube said, he's the only one that makes the complexities of what Frank Frobosi wrought somehow in the King's English. Ian Lyngen is with BMO Capital Markets. Can't say enough about his morning note. Look for that. Get that from the Bank of Montreal, BMO Capital Markets.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We start strong with Seema Shah, Chief Global Strategist, Principal Asset Management. We're going to try to talk to her without mentioning DeepSeek and all the rest of it. Seema, when you see a shock like we saw yesterday, for measured conservative 3-year time span, do you buy the dip? Do you take a long lunch? What do you do?
Hi, Tom. Yeah, look, yesterday was a tough day, mainly because there's so much uncertainty. I mean, there's something that I think we've had time to digest the impact, which makes it a little bit easier for investors. But I think, given that the jury is still out, it is a big question. We've had so much money go into money market funds in the last, will continue to go into money market funds over the last couple of months. And when we speak to people, the thing that they keep saying, or have been keep saying, is that they're really concerned about equity valuations. Is this really the time to go in, particularly when they look at tech valuations and they say, look, they're really, really frothy. So after today, is it a buying opportunity for Mag 7, or do they, kind of keep a step back? And I think that the uncertainty still keeps them on the sidelines with regards to big tech, but it probably does improve the outlook for, a broadening of that investment space. So I think you're going to see people come back in, seeing that the productivity gains for the US economy for a number of US sectors and globally, of course, that there are other opportunities. So I think it's almost like a pivot into different areas of the market, which actually should be healthier.
I look, Seema, at all this, and I look at people in money market funds, and the surveillance exuberant meter isn't ringing a bell. Are we exuberant now into this Fed meeting, or is there a leadenness to desire to own equities?
I would say that there's not that much exuberance, mainly because there's so much uncertainty. I think everyone is in agreement that, look, the economy is looking pretty robust. The prospects of recession are very, very far out, which should mean good earnings growth for 2025. But I think that when you have so much uncertainty, firstly with the tariffs, what's going to happen with the fiscal space, and now, of course, with DeepSeek, it's a difficult time, I think, for investors to really put that exuberance to use, even if the macro backdrop is very constructive.
Speaking of buying the dip, Vanda Research put out some data on retail investors specifically, and they bought a record amount of NVIDIA stock during the sell-off that we did see on Monday. So Seema, when you're speaking with your clients, how are you advising them to position?
So what we're saying is that this is a time when you really do emphasize not just global diversification, but diversification across sectors. There has been so much FOMO over the last couple of years. Investors who really didn't get into the Mag 7 have been waiting there. And so, if they've had anything, they've put that money to work in big tech. Now, I think this really does accelerate the point that global diversification is key. Valuations, maybe a lot of across the space in some places still look expensive, but that's not a reason to avoid them. So places like India, Japan, we continue to like. And then, of course, there have been some tactical opportunities in Europe and, of course, China now. So I think that's key, but also looking beyond the big tech. So sectors within the financial space, particularly, we think are looking stronger, potentially within industrials, if you do start to see this manufacturing kind of green shoots start to take off. So I think that's what we're advising investors. This isn't the time to sit back and cash, but you start to recognize that there are opportunities outside the spaces that everyone's been very much limited to over the last few years.
There's been so much criticism over the past 2 years in this bull run about broadening rally. If you look at the SPW, the equal weight index for the S&P 500 was up just marginally yesterday compared to 1.5% drop in the S&P 500. And then, of course, another strong breadth day with 57% of the New York Stock Exchange higher trading there. So when you're thinking about the broadening type rally, where do you see as far as when it comes to earnings growth and how that could translate to stock performance over the next year?
Yeah, and I would say that the fact that that broadening of the rally, which has been spoken about so much over the last couple of years, hasn't really taken off, has just added to this kind of idea that actually, look, the only thing to do is the big tech. So I think that it hasn't helped, but we do think this is going to be a fairly good year. So in terms of spaces, one of our favorites continues to be financials. From a macro space, of course, you've got a strong economy, you've got a positive yield curve. Just so from a fundamental perspective, financials do look good. And then you add in the deregulation that we're expecting to come through in 2025. And it looks like quite a resounding case for financials at this point.
Seema, I got to be quick. What kind of financials are the attraction that you see out there? I mean, is it like load the boat on JP Morgan, or is it big banks? Is it regionals? Am I buying Paris? What am I doing?
So we think the US big banks are still good buys. I know, look, they're expensive, but of course we've never seen over the few years. Expensive doesn't mean that there's going to be a correction. We also actually like some of the European banking space, fundamentally not as strong, but actually have been very much unliked, and from a valuation perspective, looking pretty interesting.
Okay, Seema, thank you so much. Greatly appreciated today. Seema Shah with Principal Asset Management.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
The daily look at the front page is a Lisa Mateo moment. Lisa, what do you have?
Okay, so there used to be the social media trend where people would show off everything they bought, right? They would call it a haul, and they'd show off all these things they're doing. The kids were going crazy with it, showing off things at like Target and Amazon. Well, now there's a new trend. I'm excited for it because my daughter will spend less of my money. It's called No Buy 2025. So they're not buying. That's the whole different trend of it. So they're making lists of items that they won't buy. Some are promising to buy like these non-essential things that they used to buy all the time. But it's not just kids, though. It's adults, too. Like they're cutting back on the hair treatments, manicures, streaming platforms. So this is a new thing. People wanting to not spend as much in 2025 as they did in 2024.
What's a hair treatment?
A hair coloring, blow dry. It costs very much.
Are you thinking about one, Tom Keene?
This is a very expensive upkeep.
It's just the hair treatment thing is the biggest racket going.
I see
feel
like
these
you're
lines. I look on the phone and there's multiple. We're very treatment. Are we really going to spend less?
Yeah.
What do you think?
And I feel like you should try it.
Yeah, I should. Taylor should as well. What's next?
Less to the Tiffany store. There you go. So someone who did not get this no buying memo was Taylor Swift, because she's all over this is Business Insider. She had the foo. You talked about it yesterday. The Louis Vuitton retails. The whole thing had to total about $68,000.
Wow.
There is a complete breakdown. But the thing that stands out, it was kind of controversial because she had the monogram jacket, which is different because it used to be this quiet luxury trend, and now she just put it all out there, and it was Louis Vuitton everything and branding. So they're saying she's going to spark back this loud luxury trend instead. But
I wonder about it in the sense that so many people I know feel they can't wear luxury because of crime. This is serious stuff.
I didn't think about that.
It's like serious stuff, and I just wonder I noticed the tailor outfit. Wait, let me rephrase that.
Yes.
It was noticed in the
head to toe.
house.
Yes.
But I really wonder.
The jacket was $5,000 alone.
Wow.
Yeah. Well, she's
Wowza.
styling.
She's
and
styling.
they want-
She was looking good though. She was. Yeah.
She's
looking sharp.
Next.
She did. All right. Since we're talking luxury, this was in Fortune magazine. Kind of interesting because it talks about Disney World, and they're calling it actually a luxury experience because it's become this, tiered pricing scale, add-on fees. It's becoming unaffordable to just the average American family. So it really breaks down the price. You got to read it. It's pretty interesting. But over the last 10 years, Disney World ticket price has grown at almost 9 times the rate of inflation.
Yeah.
So a family of 4, $766 pre-tax for 4 one-day peak season tickets. And they're talking about the perks. It doesn't include the extra perks, like you need the lightning pass if you want to skip the line, the extended evening hour pass. That really the haves can afford and the have-nots just can't. So it's just kind of interesting.
Paul
take.
keeps
Yeah.
track of this.
Yeah.
I don't really.
It is
participate,
it's a lot. Thank goodness my kids are older right now and I don't have to go through this. But it's a lot.
It's
and
like
a lot of
700
parents
it's like
talking
skiing
about
now.
it. It's ridiculous. They're saying Universal Studios is going to cost like $100 less. If you go to Busch Gardens, it's going to save your family like $300. It's just paying for the name. Yeah. Mickey Mouse.
Okay. Well, thank you so much. Lisa Mateo on the newspapers today.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.